was a very nice summer. I had an opportunity to take some time off, do some travel, and more importantly, I had an important project done. Hopefully, you'll notice in the following slides, but I'll be sharing that towards the end of this update. Greetings, viewers. You're watching Aman Sangha, independent financial advisor in Mississauga, Ontario, for my mid-September update. As always, I'll break it up into three main components. We'll start with the index returns, which is the driving theme that connects through to the second, inflation, and the third, the status of the Canadian GDP. So without further ado, let's get started. This is end of day September 15th. Friday, there was more bleeding. So it's about, you're seeing the numbers, they will be further down by, I think, another whole 1% point. But there are no surprises in this. There is a lot of red in equities, and a lot of red in bonds. In fact, if there is one theme that's coming out very strong, is that the bonds are in bear market and in bear market territory. If you just from a point of statistics, this is the first time in the last 30 years that we've seen such a deep drawdown in bonds, that we are seeing a bear market in bonds. Bottom line, you might just ask, why is the drop down? So we know that the bond, as rates rise, the bond prices fall, and underlying reason is the rising rates, which are happening because there is more inflation. Which brings me to the second point of this update, which is if you look at inflation, this is a graph from Atlanta Fed, where the inflation is broken down between sticky and flexible components. And another easier way to understand it is just think of it as goods or services. When you think of goods, a large component of that is gasoline, which has come down. So some of that is reflected in the goods inflation peaking off. But when you look at services, a large part of that is wages, which are still rising. And with rising inflation, that's forcing the central banker's hand to raise rates faster to make sure that this is under control and it maintains the monetary policy stability in both countries, US, Canada. So if I translate this back to into the Canadian scenario, you see the same story. You see the goods, they seem to have peaked. We're seeing some slowdown, primarily driven by gasoline. But if you look at the services, there is no slowdown yet. And if you have to go back in history and look at any parallels, you can see that the goods are peaking a good few months before the services peak. And so there is time, and it might not repeat the same way this time, but if we assume or hypothesize that the goods have peaked, it'll still be some time before the services peaks and we see any significant change in the direction. And that's primarily the message around rising rates, that the central bankers need to tame this and get this under control. So going to central bankers in Canada, we've seen the Bank of Canada come out with two rate hikes of 50 basis points, and then it was followed by 1% and then a 75 basis point. And they haven't indicated that they're done yet. So what this means is that the rising or borrowing costs are definitely increasing. And surprisingly, the economy has been very resilient. I mean, we are seeing slowing growth, but we are not seeing a decrease in growth. And that is the main thing, that hopefully the combination of a slowing economy would be the trigger for the bank to indicate that they're done with rate hikes, but that's not the indication as yet. So if you look at it from a Canadian economy perspective, we have the housing market, which is very sensitive to the rates, which if you look at it from a Canadian perspective, contributes about 10% to our GDP, versus US, which is about half that. It's about 5% there. So the Canadian economy in all is overall more sensitive to interest rate hikes because of the higher reliance on housing as a component of its economy. And we are seeing that flow through in terms of job losses. We are seeing some job losses show up, but not significant enough for them as yet to see a decline in growth in the Canadian GDP, decline in the Canadian GDP. So with that, I just want to conclude. If you have any questions, feel free to give me a call, 905-363-5035. Also, this was the big announcement. I have a new website, amansanga.ca. That was my summer project. Glad that is wrapped up in time. That allows me to spend more time on other things. But any feedback you have, feel free to call me or email me. The contact number is always there on the website itself. Thank you so much for watching, and I will be back with my regular monthly updates going forward into the rest of the year. Thank you so much, and bye for now.